Since the inception of American history in 1776, Americans have always found themselves divided, but then have always come back together. We were once loyalists and patriots until Thomas Paine wrote Common Sense and brought us back together. In 1796, when Thomas Jefferson and John Adams were at odds, it was Alexander Hamilton who brought Americans back together. Why? Because homeownership. John Adams, our second president, first vice president, said that property must be secured or liberty cannot exist. Thomas Jefferson said it's the small landowners who are the jewel of American history. And now we find ourselves, the American dream of owning a home is out of reach. Fast forward, for most Americans today. And right now, we're too divided to address it. Don't take it from me. Denzel Washington, talk to me.
I think we as Americans need to put our elected officials' feet to the fire and demand that they work together, or they won't get back in office. You know, in this age we live in, this accelerated information age, we're getting further and further apart. We're not getting together, we're getting further and further and further apart. Everybody can't be right. But I think this is an opportunity, actually. You see how people are being energized and protesting and all that. But I think this is an opportunity for us to look at ourselves as a country and say, are we together, really? And are we holding our elected officials accountable to making sure that they're working together? Not just, hey, you're on your side, I win what I win, you win what you win. Because this is what is happening. This is what's happening. And God only knows where it's going.
My name is Nick Gouché. I'm the founder of Nation of Homeowners. And we're on a mission to unite Americans again around this concept of the American dream of owning a home. What can we do? What policies exist? What can business leaders do to help us get back on the path for most families to achieving that American dream? With me today, a special guest. He's a mentor, he's a friend, he's a national business leader, he's a co-founder and CEO of Panorama Mortgage Group, Jason Madiedo. Brother Jason, welcome to the show. How's it going, boss?
Thank you. Great. Thank you for having me and bring me back.
I got you, brother. Of course, man. But look, really important that I had you on the show for this reason. I don't think most people understand this, but in the next 20 years, Jay, most Americans will look like you and me. Okay, this is happening right now in real time. By 2043, the majority of Americans will be people of color. For the first time in American history, there are more people of color under the age of 18 than any time before in U.S. history. And so we wanted to build a show that could bring people from different backgrounds, of different skill sets, of different thought processes to the show to talk about what's happening today, what trends are taking place, getting some feedback to find out what can we do to make the American dream possible again for the majority of Americans today. That sound good?
Simple.
Never easy, but simple. So what I'm gonna do, man, is there's a few things happening in the news today. We want to play a few clips. Let's just have an open conversation about what you think, what this means for us, and how we can use this to leverage going forward. What'd you say?
I said there's a lot happening in the news today.
I know. Well, we'll pick the ones that come to mind right now. But eventually, for us, it was really about creating something that was nonpartisan, Jason. That it truly didn't really have a place left, right, and different for us. We're Americans. I think you have a family, you have a growing family as well. You have grandkids now, Jay. And so I know you spend a lot of time thinking about the future, as I do too. And so that's the purpose, that's the vision. And so there's one of the policies that have been happening right now across the country. You've heard about it. President Trump and others have been talking about the role of corporate landlords. Okay, that's when it comes to homeownership. I want to play a clip for you, then get your take. That okay?
Yeah.
Amen. Okay, let's go.
Homeownership has always been a symbol of health and vigor of American society, but that goal fell out of reach for millions and millions of people in the Biden era because interest rates went up so high. Today, I'm taking action to bring back this bedrock of the American dream. In recent years, Wall Street giants and institutional investment firms, many of you are here, many of you are good friends of mine, many of you are supporters. Sorry to do this, Joe, I'm so sorry. But you've driven up housing prices by purchasing hundreds of thousands of single-family homes, and it's been a great investment for them. Often as much as 10% of houses on the market. The crazy thing is a person can't get depreciation on a house, but when a corporation buys it, they get depreciation. Okay, that's something we're going to have to think about too. I don't know if too many people think about that. You buy a corporation, they buy 500 houses, they buy hundreds of thousands, they buy 500 houses, they can take depreciation. A person sweats and works and buys one house, they can't. But homes are built for people, not for corporations, and America will not become a nation of renters. We're not going to do that. That's why I have signed an executive order banning large institutional investors from buying single-family homes. It's just not fair to the public. They're not able to buy a house. And I'm calling on Congress to pass that ban into permanent law, and I think they will.
Jay, I know you've seen it. I know you own several properties yourself. You're not a corporate landlord yet, but perhaps you will be yourself eventually.
What defines a corporate landlord?
I believe if you have over 100 doors.
Oh, okay.
Yeah, so it's a larger number.
Not a corporate landlord.
But that concept, that policy of banning corporate landlords, large corporations who don't intend to live in the property, who intend to create forever renters, your take on it and what role you think that might play in impeding the home process for people to own properties. What do you think?
I think it's, well, frankly, I think it's a day late and a dollar short. Because it's like when the government tries to get ahead of private, corporations or capitalism, it's tough because capitalism is very smart, right? Revenue and profits and all of those things drive a different behavior than I think some political policy. But I say it's a day late and a dollar short because a lot of the acquisition that was happening was past. We were already seeing downward pressure on prices on properties because of the upward pressure of interest rates. And so I would imagine if you measured the purchase of corporate buyers over 25 and even into 26 with or without the policy, shoot, I would even gauge 24 even. You would see that sort of decline because of maybe the fear of the asset. And so all of that said, and that corporate America still represents like 5% or less of all purchases anyways. There are some pockets of real estate or market. There are some markets, some pockets, some cities, some micro economies that were maybe unfairly targeted by some of these companies where the purchase saturation was higher, right? 10, 20%. Well, that's 1 out of every 5 homes. That is a problem. But I think that has stopped for the most part. And I think one of the most important things that, if anything, if our government can help with anything in terms of policy in regards to helping homeownership, they have to skate to where the puck is going. And I don't think that's happened in this particular one.
What do you think, by the way, well said. I have a few thoughts about that too, but where do you think the puck is going?
Well, in regards to policy, or
you can take that however you want. Either direction. Policy, private market practices.
Yeah. So I think in policy where it probably should go is probably around tax relief or tax benefits for a homeowner. I think that's the fastest, quickest route to increase affordability or incentivize homeownership from a government, right? From a policymaker's perspective, because it's really hard for them to control anything outside of those type of general policies they control. And I think it's faster from my perspective. So, for example, I would rather saw the ability to write off maybe some more maintenance, some more homeownership expenses on a primary resident rather than investment properties. When you hear the president talk about corporate buyers, he talks a lot about the tax advantages they have. Well, because corporations have tax advantages. When you're not living in the property, there's a whole nother set of tax advantages. Well, why not give those similar tax advantages or a subset of those tax advantages to a owner occupant that incentivizes them to own the home, that actually incentivizes them to spend money on the home and really, right, spread the money out, which is maybe even more important from an ecosystem perspective. As far as affordability, well, it's just all about supply. The supply needs to increase, whether it's the organic existing home supply that comes on the market from aging consumers, or builders, or job market issues, economic issues where foreclosures become part of the housing stock. Whatever it is, we just need more supply that'll sort of normalize the prices, interest rates to maybe have a little downward pressure. I think that doesn't hurt because prices are so high that it's that payment gap. It's the payment that's tough, right? So I think that seems to be somewhat on the horizon, although every day is different right now.
So this is really good and great masterclass. So here's the synopsis of what I'm hearing you say, Nick. There's about 80 million or so primary houses in the U.S. If it's true that 4% or less, own corporate landlord housing, that's 3 to 4 million units.
Yeah,
there's 76 million, which is not even a dent, right? That's the thought process. You say, Nick, there are some pockets, the Sun Belt, North Carolina, Atlanta areas where you saw, in some markets, you saw more non-owner landlords and first-time home buyers, right? In many small pockets. But what I'm hearing you say is that in 2010, coming out of that recession, Jay, in 2010, private equity firms were flush with capital and with housing supply available, with cost of the homes being so low and rates being essentially at zero between 2010 through 2020 for that 10 to 12 year period. The buying spree took place during that decade or so. And so now most of the housing supply that was purchased by corporate landlords have already been purchased. Now that the quantitative easing has been lowered, right? Now it's much higher again. The money is now much cheaper in terms of borrowing it. So as a result, they don't see the same value in owning more of those assets. And so they've already moved on to perhaps other investment supply. And so the government now coming in trying to ban corporate housing is indifferent to them at this point.
Yeah. It's if the markets are typically ahead of the action or the result, and they're predictive enough, then they did the same exact thing. I'd say that corporate buyers bought even up until about 22. I think that was sort of like they were in that sweet spot, right? And you can almost see it with the rent increases, right? And then sort of rental pressure started to have downward pressure, obviously, because interest rates went up. And so mortgage payments were higher than rents, blah, blah, blah. And so, that sort of created the recipe, I think, of slowing them down. And money costs a little bit more. And uncertainty sort of drives you. But I think it lasted until about 2022, at least as far as I could see.
Yes, about a 12,
Sort of in that
13-year window of time.
Yeah.
Interesting.
Yeah.
Okay, so then you believe so that policy, from your perspective, would have minimal impact on affordability at this point. Is that safe to say?
Yeah, look, I mean, you can argue that they bought the necessary housing stock that could have helped backstop the market, but builders could have also built the necessary backstop. And you can make a lot of arguments. You can also say that the natural order of real estate, of buying and selling real estate, with certain cohorts aging out, second home purchases, or familial upgrades, all of those things were stifled by all kinds of different things. Interest rates rising, people stuck with low rates, not stuck with, but having low rates, so not wanting to get out of that particular home because, how am I going to afford the next house? There was a myriad of things that happened, and this was just one of them. So I wouldn't just sort of call this the culprit. In the sense, you know what I mean? I think it could have, yeah, sure. If one single thing would have stopped, you could have backstopped some of the inventory. I don't know. Something else would have come. That's just how the universe works.
Got it. Jason, very unique perspective. I think that your expertise, your thought around it, I think is in line, is in balance. And perhaps the biggest takeaway is you said the smartest culprit in all this is capitalism itself. Right, the free market has a way of reconciling its own differences, and so really, from your vantage point, the real key is try to unlock the free market to solve its own problems.
Yeah, I think it's maybe scary for some, but I think provide the competitive advantage, because capitalism will always win. In our case, at least it'll outsmart. And it'll be faster. It's speedier. So I think what would be great today would be a whole new tax deduction plan for homeowners. I mean, include insurance. Tell me that hasn't gotten expensive.
You said insurance?
Yeah.
Oh, yes.
Include
Wait, Jason, hold that. We wanted to get to that too, Jay. 100%. Absolutely. Okay, I love that. For those of you out in the social world, comment, engage with the conversation, your thoughts around it. Do you believe that the free market is the best solution to solving its own problems? Anytime there's too much government intervention, do things always get worse? I think it's President Reagan said the worst thing you can hear is somebody say, I'm from the government, I'm here to help. So it's not always the best.
That's true. I remember that. I think the role is to protect. Right? To be a social servant, to protect from the bad elements. And so, I may be oversimplifying it, but
sure.
I'm not sure if overreaching, where does overreaching sort of start and stop? And we won't get it.
That's actually a good segue, because beyond that, there's a lot of noise happening right now in Florida with regards to property taxes. Just recently, the House just passed a bill, I believe 80 yeas to 31 noes, that is looking to possibly end property taxes, Jason, in Florida. This is a concept. I'm going to play a quick video so we can catch up, and then I want to get your take on this too. Is that cool?
Yeah.
Sir.
Tallahassee House Republicans passed their plan to give voters the choice to get rid of homestead property taxes that don't fund schools. Their proposed ballot amendment also locks in minimum funding for law enforcement and public safety. West News' Justin Shecker spoke with the Seminole County tax collector. He joins us live from his office in Altamont Springs. Justin.
Well, like the Democrats in the legislature, Stu, this county's Republican tax collector wonders how counties and cities would make up for a major loss in revenue. The Republican House Speaker says the resolution approved today could set the stage for historic property tax reform.
80 yeas, 30 nays, Mr. Speaker.
Show the bill passes.
The Florida House, along party lines, passed a resolution Thursday that could give Floridians a major property tax break.
This may well be the most aggressive legislation ever passed by a legislative chamber on property taxes in the history of the United States.
For months, Governor Ron DeSantis has called for the complete elimination, but the House resolution preserves homestead property taxes that fund public schools.
Our actions today are not sudden, nor do they meet any reasonable definition of the word quick.
The Florida Senate still needs to approve the proposal before a constitutional amendment would appear on the November ballot.
We are here to address putting money back into people's pockets. We are also giving our people a choice.
According to the state's own estimate, the elimination of non-school property taxes would result in local governments losing $18.3 billion in annual revenue. Orange County could be down more than $1 billion, while the projection for Seminole County is $328 million.
Where they get the money from, if they don't collect it from property tax, is a mystery.
Seminole tax collector J.R. Kroll says counties and cities might need to increase sales tax rates to pay for police, fire, and other services.
And say, well, we'll do it at a sales tax. I go, well, in a recession or something like COVID happens, what happens when you don't get the money in because people drop off?
Orlando's Democratic State Rep Anna Escamani says she worries wealthier Floridians would benefit the most.
What it's likely going to do is shift the burden of taxation to renters, who arguably are the folks who are struggling to achieve the American dream of homeownership.
Brother Jason, property taxes have been paid for by Americans for 400 years. This is a very innovative approach. I have some thoughts about this, but I would love to know your thoughts around ending property taxes as a way of improving affordability. What do you think?
Ending them altogether. So are they ending them? I mean, it seemed like they're probably capping for some and ending for maybe there's a kind of a. I don't understand the complexity.
Yeah. So by the way, it passed through the House. It still has to go through the chamber, so there has to be a secondary vote on this. Number one. But I believe to your point, yeah, it's probably going to be not a property tax, maybe like a tax allocated maybe for schools or public works potentially. And so, for example, what that could mean net benefit, I looked this up the other day. So Florida's property tax rate is about 0.8, okay, 0.8%. Average median home price is $405. So the average family pays about $3,000 plus in property taxes, right? And so this could mean maybe $1,000 in taxes potentially. Another $2,000 kind of goes back in the pockets of the homeowner. What do you think?
I mean, I think this is such a big issue because states highly depend on this revenue. Florida, correct me if I'm wrong, is a pretty well budgeted state. And so they're either giving themselves problems they know they've anticipated how to solve, where maybe a state like California might be a little harder to solve. And different states do different things. I mean, Florida doesn't have state income tax, either does Nevada, right? A lot of its tax revenue comes from property taxes. However, I live in Las Vegas, right? And a state like Nevada for new home construction has layers of taxes for service things like schools, law enforcement, fire, parks, etc., things like that, right? They have to be funded somehow with subsidizing them. I don't know what this would do to open up for supplemental taxes, because that may happen, right? That doesn't rule out supplemental taxes, which is more uncertain, although they can happen anyways, I guess. On the surface, reducing the cost for someone to get into a home to create wealth in America through real estate is a good idea. It's an important part of the American way, I think. How that's accomplished, I do think to some degree, taxes on new construction follow the new home price, which additionally sort of push people out of homeownership, because in some states, if that house that was originally purchased for $200,000, because you said $400,000, So it might have been originally purchased for 200,000 and it has a tax basis at around 200,000. And that's what that owner has been able to enjoy that basis for a while. And then a new buyer comes in at 400,000 and now they have this new, very much larger tax base or tax cost. Same rate, different cost, right? And maybe that could be addressed differently, maybe sort of wean into it. But everyone's different, and it's so hard to look at Florida as, and it's just for Floridians because, for example, in Nevada, if the older the home, that tax base, if you're buying it from the original owner, actually follows the new owner. That's a huge advantage for a new homeowner, right? And it does go up over time, but it's like you get to wean into it a little bit. And so some states have done a good job on this, some states haven't. So it's hard to really opine other than whatever we can do to create affordability is important.
So, Jason, let's circle back to Las Vegas or the state of Nevada. So walk us through that concept. So if someone bought a property in 1987, okay, for $100,000, and the tax rate is, let's say it's 1%, it's $1,000.
Yeah.
Right. And now somebody buys a property 30 years later. Remind me again? You said if they buy the property, they're going to take the tax basis of the original owner who they bought the property from. Help me unpack that.
Yeah. So, okay. So, you know what? I'm going to give you a real example. My daughter just bought.
Okay.
And she bought a property from the original owner who, I can't remember off the top of my head exactly what their tax base is, but they bought probably 20, 30 years ago. And now she's buying in 2020. Did we close this year? Well, in 2025, early 2026. And their taxes for this year going forward are the same taxes for the owner who's owned it for about 30 years. Somewhere.
Now, Jay, are you saying the tax basis or the actual dollars in property taxes?
Sorry, the actual dollars.
Dollars.
I should have said the dollars. So the actual dollars that they're paying annually is the same dollars that the previous owner paid, which for about closer to $500,000 property, it was about 470. 470 is going to be around $3,000 or less a year. That's a great rate for an entry level consumer who's stretching already to get into the 400s, because what else are you going to do, right? Well, you got parents like me going.
That's what I didn't want to say that. I'm not going to pocket watch here, but they bought a property for $500,000 in Nevada. It's not so bad.
But it's kicking and screaming too. But you're right. You're right. I shouldn't. It's sort of.
Go ahead.
Well, it's pushing them through,
right?
And I think that's another topic, which is you have to push. I mean, it's so hard. It's a scary thing, and I think you have to go. Look, you got to do this. It's going to hurt, yes, but it's going to. You're gonna thank me in about 10 to 15 years. Maybe less, maybe a little bit more, but you're going to be happy. And there's a lot of reasons why. And that's why you're going to suffer a little bit with this payment, because that's what it takes. Okay. And that's how things are created, not through easy, but through pain. And so I think, but that tax base, back to that tax base is super helpful in this first year. In 2 or 3 or 4 years, maybe that'll get reassessed over time. And they'll be able to wean into it because there's a cap on how much it can increase every year until they get there. That's a state doing the right thing, I think, for first-time homebuyers. If that same homebuyer buys a brand new construction, well, it's a new construction. The property's never been assessed. They're going to get fully assessed at the purchase price rate today. That tax rate is going to be very different on the new construction than it was for the same price, right? For the same price. It's going to be the same, about 0.875. It's going to be the same.
Got it. Interesting. So from your perspective, and perhaps where I'm here too, is ultimately there has to be some relief. but you have to also weigh the pros and cons to both. For example, going back to this video, if it's true that Florida, I believe, makes somewhere around $19.8 billion a year in property taxes. Something everybody pays at the median price point range, right? And if that's used for infrastructure, for roads, for schools, police officers, firefighters, then the question becomes two-part. One, Jay, I do think that it shows what could be possible with well-run states. Okay, I think there's something to say there. It's no different than you and I in terms of how you manage your own household finances.
Sure.
The same way a state
I
should
agree.
do too, right? And so the concept is that so when you do manage the budget, there is more room to create incentives to kind of drive down costs in other areas. Now, from your point, you're saying, hey, Nevada has not eliminated property taxes, but they have perhaps reduced the entry level cost for what you would normally pay. For example, I'm in California. Okay, that basis is not passed down. So once we buy a new property for $800,000, we're paying $10,000, Jason, on that new purchase. We
Within
don't get
12
that grandfather
months or less.
right
Right away at the close, or
right away,
shortly after.
right away, right. And so it drives down, capital allocation in our bank account because we're bringing more money to actually close.
Yeah.
It impacts the
point.
PITI, right, the buying power as well. And so I do think we have to think about who's paying for all of this and holding our officials accountable on balancing the damn budget. Because if the budget's not balanced, Jason, then really there is no room to provide these kind of incentives. I'm thinking about California right now. Even if California were to look at Nevada, you're right. We're the fourth largest economy in the world. Okay, and still sales tax, property taxes, state taxes, they're at an all-time high. And so if you're in the state, it's very difficult. If you're a two-parent household and you do well, it's very difficult to find additional cash flow to be able to pay down the down payment or afford to buy a home. And so being able to be innovative is possible when you balance the budget. Same thing for you and I in our own homes. And so I think it is interesting to look at how states make their money. Property taxes is one key. Sales tax is a big part too. But thinking of ways to pass down the savings to entry level buyers is important to give them the opportunity to sacrifice. To your point, you said you told your daughters, perhaps think about buying a home and just going forward, being able to cut the cord where you can. It will hurt initially, but to your advantage or to your example, your daughters have benefited from that state-based tax policy. Is that correct?
Right. Exactly.
Right. So yeah, no, I think that's critical. So most definitely looking at pathways to drive down cost. I mean, Jay, imagine that. Can you see a world where there's no more PITI, just PII? You think about that?
Right. Imagine. Yeah, I don't know. I think you states like California, when you think about homeownership in mortgage and mortgage finance, the three largest states in America by far are California, Texas, and Florida. So
by far in terms of what, population or
volume, population, volume of mortgages.
Okay.
So it doesn't matter what is happening in the economy. It doesn't matter what the average price point of a home is. California, Texas, and Florida are always the three largest real estate housing markets in America.
Are you saying by unit count? By units?
Yep. And volume.
Okay, yeah. Volume, yes, because the average price point is $825, right? $850. So I'm with you there.
But,
So
I mean, New York has higher price points, but they don't have more volume. So California, Texas, and Florida by far is like the large portion of mortgage finance, real estate movement, housing, all of that. Now, I'm not saying all the other states don't do a lot. I'm just saying the largest.
got it. Okay. So let's stay here for a second, because I do wonder, and I know you have the data. Maybe you have all the Straightmore data, you have all the HMDA data as well that backs that up. I know that you do. Here's a question for you.
I just make it up as I go. 64% of statistics are.
No. Here's a question for you, because I do wonder how how long that lasts. If you look at the last 4 decades of homeownership in California, one, there's 34 million people who live here. Okay, there's 14 million households. So of course, so sheer numbers and volume is going to get you there. Okay, by unit count.
Yeah.
I'm with that.
Right.
But if the objective is to drive possibility for that to be true for millennials and for Gen Zers, then ultimately that won't be true for long. Because if you are a single person, if you are a married person right now and you make 75 grand a year, right? So you have 150, but then you're strapped by student loan debt, you're strapped by credit card debt, you start your adult life in debt, and now you want to still live in a great state like California, then that won't be true for long. And so ultimately, I do think about not just the data today, but we want to build a company of real meaning and significance, which means we need to be able to do this for people who are not yet crossed that threshold. And so I think Texas has a different objective than, let's say, California and how they're going about solving this problem. And so, yeah, I'm with you in that sense that the numbers have been the case, but I don't think it'll be that way for long.
Yeah, I don't know. I've been doing this for 32 years, and I think for the last 20 years of it, we've said California is not going to be doing it for long.
Here we are.
But yeah, it's funny. But you know what I think you should look at, and I know you're a data guy and you love this, is look at people exiting California and look at birth rates. How many births are happening in California? And California is such a monster of a state. You said it, fourth largest economy.
Yeah, in the world.
That
right.
It is backfilling its loss. And so now, sure, that baby needs to get of age. Will they leave? Will they stay? Well, if your information is correct, which you said by 2043, most of us are going to look like us.
That's just American. That's just really demographics. Yeah.
Okay, so it's harder to leave your family. Culturally, it's harder to get up and go, I'm out of here, because you're held to a different standard. Your culture and your upbringing is slightly adjusted for familial responsibility economically. And so I think I think that's where California probably can win, is less, more kids are happening, offsetting the people that are leaving. It's like California feeds the rest of the country with population.
There's too many of us here anyway. By the way, this is the context, Jay, for this show is we do want to bring on ideas, and even if sometimes the ideas might come into conflict with each other in terms of how I think.
I love that.
We might think, right? But the key is we do want to bring back open debate and open dialogue, because to your point, capitalism worked because freedom of thought works. I think that's the critical point, is being able to have a conversation, right? And say, you know what? So when I hear you say that, you say the birth rates are being replaced by the exodus, but then you got to factor
some
in.
of it.
Some, right? Offset. Some. But then you got to factor in immigration, because obviously not all birth rates are, that's a whole other conversation in terms of who's actually being born in California and those economics that go along with the people, right? And so if the average family, for example, to your point, Jay, if the average family that's leaving Texas or that's leaving California leaves with a $185,000 household income, okay, and the baby's being born into a home, are in an income that is not the replacement.
That's a great point. I see what you're saying. You're saying the ones leaving are leaving with the income. The ones being born need to be supported.
That's right.
And there may be a burden, increasing the burden. And you know what? I don't know enough, and I don't know the data around that to know enough. How does that sort of work economically for exactly. How's the math? But it's true what you say in terms of debate. I mean, think about it. If both of us had the same opinion exactly, then one of us is not necessary.
Listen, there's 1.3 billion people in China. They all think the same. No, but I think, no, wait, but
not deeply. They just can't say it.
That's right. That's right. That's right. No. This is. I think this is really good because ultimately, and even here, we're going to invite Jason, politicians, policymakers, to talk about their case.
Great.
Because we do want to do this. So this is okay. I love that. So for those of you here, comment in the chat. What are your thoughts about it in terms of property taxes? Should property taxes take it all the way through for states well run? Like Florida, who believe that if you own the asset, if I own stock, I don't keep paying stock on an unrealized gain. I pay it when I cash in on it. But in terms of an asset, it's the only asset owning the property. If I own the asset, I don't realize the gain. I'm still making the payment against it, but I'm paying more for it. That's the question. And so shout out to Nevada, who's found a way to create a hybrid model around it, but we have to find more relief for average families today to become a homeowner. I love that. All right, Jay, next one, because you mentioned this earlier, property insurance, Jason. Property insurance. So there's an article, Solomon, if you could bring it up, that we just saw a week or so ago. In the last year or two, home insurance, Jay, has increased by 21% across the country the last 2 years. So at the same time, homeowners insurance availability and present challenges are in many markets, premiums have increased, Jason, 21% nationally over the past 3 years. And Jay, they're expected to rise another 8% in 2026.
It's crazy.
I mean,
think
please.
Yeah, I think to some of that, it's more in. There's more impact to that increase in certain markets than others, but everyone's feeling the reverb because you need to spread. I mean, that's how insurance works. It's spread the risk, right?
By the way, Jason, take a second. We did want this podcast to be for the everyday American who's trying to unpack how all this stuff impacts them. And so, matter of fact, Jason, your true story, we have a client who's in escrow. Now they're buying a property, but they were affected by the fires in Altadena. And so I just saw a video from them on USA Today because they're claiming that their insurer has not done right by them, okay, in terms of replacing their property. And so this is a real problem happening not just in California, but across the country. So help if you can, from your perspective, how does this happen? How has the insurance, like what are the mechanics that make this so, where now it's becoming so expensive for insurance?
Well, simply, I'm going to try to be simply.
Okay.
A particular market may or may not have impacted insurance claims or a high number of insurance claims that is was unadjusted or unpredicted by the insurance company. And so they have a higher premiums paid requirement to claims received higher claims paid to premiums received. And so they're going to take a big loss on that because they didn't receive enough policy money, insurance money to pay all those claims. So when the dust settles and they start to work those claims, by the way, first things first, protect cash, try not to pay out too many claims. But even then, there's so many that it's still they're still losing money hand over foot on that they need to go, how do we make this up? Let's go spread it across all policies so that we can collect more premium to offset these claims, right? And it's simple checkbook balancing, right? How much is coming in and how much is going out? And how much did I forecast or predict was going to add? And oops, I got it wrong. Now, part of that is, climate change or whatever it is that it's happening or it's happened, but that's it. And so how do you deal with that is you got to raise the cost for everyone. It's not easy. I mean, at the end of the day, you don't want to not have insurance because things happen. And so you're kind of in a catch-22 as a consumer going, wow, 21%, right? I mean, for some people, that's going from $100 a month added to their payment to $200 a month, which is a big deal, right? It's a huge deal.
Wow.
So, and it could be more. I mean, I've heard of some crazy policies going from $1,200, one year, or $1,500 one year to $4,500 or $6,000, and it's a car payment now.
That's right.
It's a second mortgage payment. As well, take out a second mortgage just to get
HELOC. You got a HELOC.
Yeah. Right. And you know what's interesting is that flows for those that have in their payments combined in one escrowed, right? They just get a letter, right? That just changes, and they get a letter, and the bank says, because we're a servicer too, and we go, sorry, your rates went up. We had to pay it, whether you like it or not, because that's how it works. And here's your new payment. How would you like to handle it? This is how services work. How would you like to handle it? Would you want to pay it all up front? People are going, I don't got $3,000 in my pocket right now. Oh, okay, cool. We'll just let you pay it over time, right? But that paid over time is 1.5, because I now have to not just accumulate for what I had to back pay that I did in reserve. I have to go forward too. It's a whole different ballgame. I think not everyone's seeing the impact on ownership.
So that's good. So let's do an example, Jason. Okay. Yeah. So family bought a property, total payment all in, mortgage payment, 30-year fixed loan, taxes, insurance. Let's say it's $3,000 per month. And when they initially got the property, they were paying $200 a month, let's just say, for the home insurance. You're saying that as a servicer, which means you collect payments on behalf of your borrowers, right, to pay the taxes and on the home insurance. If you happen to receive a bill, by law you have to pay it, right, since you're the servicer, correct?
Yep.
So if the insurance increases, let's say double, okay, and the insurance goes from $200 to $400, usually they don't just pay $200 more. They might pay $350, $400 more, because you have to be able to collect for the backstop and still catch up for what they're going to be paying in 6 months or a year from now. So their payment could go up 30% sometimes.
People that currently own a home, yes.
Correct.
That's correct. Now, not all servicers are built the same, and some may understand that better than others and adjust payments going forward. But nonetheless, you have to catch up. There's no way around it. So sure, could you stretch it out over a little bit longer period of time? Could you work with the consumer to ease the sticker shock that happens? You could, and many do, but there's no way around the increase.
But to your point, the downstream effect is still the same. That's still an added burden,
absolutely,
to the homeowner, right?
100%.
Where do you think? So when you think about that, and you as a servicer, and if you can, Jay, take a quick second, really quick. We got about 10 minutes or so. Just give us a 1-minute summary of what it means to be a servicer for everyday homeowners today.
Yeah. That means that when you do your mortgage with a lender, which means that they originate it and fund it, there's another party that may service your mortgage. It could be your original lender. It could be another lender that bought the rights to service your mortgage. And all that means is I get to collect the mortgage payment on behalf of the end investor, the owner, which could be the markets, right? Anybody. And get to collect that. And for that, I get a small fee for managing the payment processing and passing on your payment to the end investor who owns the rights to your loan until you pay it off, because you have to pay it off. So you have 100% of that equity in your pocket.
That's right. Or you can go to Florida. There's no property taxes. I love this. So question for you. So because that's also a burden for you as a business owner to have to deal with that too, right? So how are you thinking about a policy solution, or what could be done to drive down the cost for insurance? What do you think?
And I'm generally stumped. I would say that you can You can subsidize. There's subsidies, right? Then what happens with taxes on those subsidies because they have to be funded somehow. And so you're sort of Peter, and Paul. So I think I don't have a good answer to that. I think what you can do to soften the blow is maybe property insurance is a tax deductible expense. Because how else do I offset the cost? Well, when you buy certain assets, certain things, right? When you first purchase a home, you can write off that first year all your expenses, all your purchase related expenses, plus your mortgage interest, right? Points, etc. After that, I can't really write off like fixing my toilet. Maybe I can write off my insurance because it's so expensive. I mean, I would say that's probably one way to think about it, because otherwise you got to figure out how to balance the insurance company so that the claims and the coverages make sense for everyone. Otherwise, we won't have an insurance program or insurance policies. And that we don't want. We don't want someone, losing their home catches in a fire, some sort of natural disaster, and there's no money, zero money there to rebuild, which people are going through now. Imagine if there was no insurance. What would happen then?
Yeah, that's a whole other conversation, brother. That's something. Those of you who are still with us in the actual chat, comment, let us know what you think. How should we be thinking about driving down insurance? It's now, Jason says, becoming a second mortgage for some people. And it's already hard to own a home now. Imagine with that happening too, that will be a disaster. Jay, a few more for you. Interest rates. So mortgage rates are down again it's down at its lowest point in the last 3 years. I want to say now 30-year fixed rate, conventional financing is like 5.9%. In 2024, rates were maybe 7.25% coming into the year. Last year, 6.25%, 6.5%, maybe more like 6.5%. Now we're down below 6%. What does that mean for the average homeowner today, and how should we in the mortgage lending space should be thinking about that when it comes to helping more families become homeowners? Your thoughts?
Well, in our industry, it's the old adage of date the rate. What is it? Date the rate,
marry the home.
Yeah.
Yeah.
I think there's some great opportunities right now. As I look at the market, I see that there's downward pressure on prices. Sellers are getting a little bit more open to working with buyers on price and concessions. And rates are they're below 6. I mean, that's the way the market's at. Some of them might be above 6 in the lower down payment rate, but I think you just gotta get comfortable with the payment.
With the pain? You said with the pain?
With the payment, you know what? And the pain. The payment and the pain. I think the real value in this is the staying power. And so you got to get comfortable with the payment and get comfortable with the pain of the payment. Because over time, if you have staying power, it's a great asset. There's two sides of this. Do you buy stocks? Well, the market works over time. Same concept. You need staying power. So does real estate assets. Over time, you need staying power, and you get different types of advantages. And I'm not, I do believe in diversification, but I think rates are low. If they get lower, great. You're dating the rate and you're marrying the house. Home prices are pretty good right now. You don't know what's going to happen in the future. Don't worry about that. Get in, buy, and then have staying power. That's the key.
I love that. Just to add some more color to that. If you're a family, let's say you're a 2-parent household, both make $50,000 a year because you're average working family. Mm-hmm. That's $100,000 annual income. In 2024, coming into the year, you had the buying power of a $450,000 home when rates were a little bit above 7%. In 2025, when rates were around the mid to high 6s, you had the buying power of $500,000. Today, with rates at below 6%, you have a $550,000 buying power on average, which means in the last 2 years, your buying power has increased by almost $100,000 with the same payment. That is the power of lower interest rates. And so, Jay, what we're seeing right now is if you are someone who had been on the fence to your point, and now you have two sides, Jay. You not only see lower rates, which is increasing buying power, but you also see an increase of seller incentives as well.
Right.
Matter of fact, we'll talk about more of this next week, but a survey came out some time ago that there's 500,000 more sellers, almost 500,000 more sellers than buyers. And
More
this
than
is
in
not
many, many years.
this is a new phenomenon, right? In the last maybe 13 years, we've not seen this kind of discrepancy of seller to buyer on record. And so I think to your point, there is some realism taking place now with the seller who was able to put their property on the market, had 3 to 5 buyers, if not more, to compete to move the price up to inflate it. Now you have, matter of fact, one of the things that we're seeing, and we saw this actually, I saw a study on this a day ago, that I think 1 in 6 homes, the buyers pull out of escrow. Because normally what now we're seeing now, they might be doubling up. Where they put a property, they might put an offer on a property, on one property to see if it goes in. Jason, this is a true story, Jay. So the team has a property in escrow now. They put an offer in. This is a property, family's moving to Fresno. Their child has autism, want to be close to a hospital to help give their child the care that it deserves, their son. And they put an offer on a property, I want to say Wednesday. The offer was accepted. They had another property on the market too. They put an offer on. They basically had the sellers compete for incentives.
Look at that.
Right. And so this is a new phenomenon. And so if you are someone, Jason, to your point, who believes in staying power, you've wanted to own a home for some time, but you wanted to wait until you really felt you can take that pain and still stomach, living your life. I think now has been the best time in the last couple of years. And so if that's where you're at right now, we should be talking. Our team can help you 24/7, by the way. You call 1-844-NOH-KEYS. Our team is here to help support you. So I'm looking forward to that.
Not only that, let me just add real quick.
Please.
That your team can help them be strategic in the process. Because like you talked about the 2 properties, there's a strategy when you're buying about using points, using the concessions. How are you going to use the concessions? Where does that drive my payment down? Where does that my price down? And which one is going to benefit you over a long time? It's really important because that one purchase, you do it once. The refinance, you could do it as many times as you may think you need.
By the way, that was a great promo, Jason. Thank you. That was incredible. I love this guy.
Well, it's the truth.
No. You
promote the truth.
No, 100%, man. We are truth tellers here on this show. 2 things, brother. One, you've been incredible. I have one question to ask that we're going to ask every guest here, which is why this show exists. So you have grandkids. I have 4 kids. 18, 8, 4, and 2. Jay, you have grown, daughters yourself. Let me ask you something. There's so much noise right now in the marketplace, even in this country right now. I think it's going to take a groundswell movement of people to galvanize around a common mission, okay, in order to help make some change. But at the rate that we're going, where now people under 40 for the first time, less than half own a home, right? The average age of a person, we didn't get into it, average person, there's more people over the age of 70 buying a home than people who are 35, right? These are challenges that are not sustainable. If we do nothing, Jason, and at the rate that home ownership is becoming out of reach for most families, what do you think happens to America if we become a nation of renters and we stay that way?
I don't even want to think about it, right? I think when you think about America, you think we're the land of opportunity. And home ownership was at the core of a lot of that opportunity, right? It was financial independence, building wealth, and having a home. That was the land of opportunity. What do we look like when we no longer become or when we're no longer the land of opportunity. I guess maybe we'll be asking other countries to allow our folks to go there. I don't know. I don't know. But I do know that when you buy a home, when you own a home, there's nothing like opening the door. There's nothing like pressing the garage button and pulling your car in. I can't even explain the feeling, and it's too hard until you feel it. Until you walk in your door every day and go, it's my house. Bad day today, good day today, tough day, stressful day, whatever. You just, I'm home. Like, what else can I tell you? Try it. See if you like it.
My brother, as always, I love you, man. I appreciate you. I'm going to bring you back here more. Things happen all the time. This could be a 3-hour show, honestly. But I will say, one, Jay, I know that you have built a phenomenal business. You're a phenomenal business leader, and you're building your personal brand now on social, which is pretty cool. I love that.
I'm learning.
I love it, man. And you have the big guy, Wilmer, back with you, which is like you got A-list. You got an A-list now, which is pretty big time. How do people find you, Jay, on social?
Simplypmg.com. I think that's it. I think I'm learning at simplypmg.com.
And then we got another 2 minutes. Okay, cool, Jay. And then end it with this here before I make my closing promo. Tell us a bit about PMG. What is the brand? What is the mission? Where are we going?
Wow. We're constantly learning. And I could say that I think if where we're going. So by the way, I have to say that this is our 20th year.
Wow.
So time flies, man. Time flies. It's only taken 20 years to figure a few things out. And so if we figured anything out, I think we figured out that what we need to provide our customers with is a simpler process and a better price. And so now we are just hell-bent on trying to deliver that. How do we create a simpler process and a better price? We've talked an hour about affordability. Well, our contribution to our affordability is figuring out how to do it at a better price and making it a little bit simpler.
Here's to the believers, the ones who still believe in owning a home, not just for walls and a roof, but the American dream, alive and within reach. Here's to the ones who don't buy the lie. We're too different, too divided, too far gone. You know we've been here before, and you know there's a way forward. We, Nation of Homeowners, is not just another mortgage company. We are a movement, a revolution. And together, we will do our part to make the American dream possible for most families again. Enjoy your evening. Hope you enjoyed this episode. I will see you next week. Let's go.
Cheers.